Without further ado, it is my pleasure to introduce Adrian Day. He's the chairman and CEO of Adrian Day Asset Management. He's a London School of Economics graduate, specializes in global diversification and resource equities. Mr. Day is the sub-advisor to the Euro-Pacific Gold Fund, and his latest book is Investing in Resources: How to Profit from the Outsized Potential and Avoid the Risk. And to our live viewers, if you have any questions for Mr. Day, please put them in the chat box, and time permitting, I will get to those at the end of his presentation. And with that said, Adrian, I'll be right here if you need anything, and the floor is all yours.
Well, thank you very much for that introduction, and good morning, ladies and gentlemen. Thank you for joining. So I'm going to, the topic is this gold's year? And I'm going to look a little bit at some of the factors that influence the gold price and some of the factors that people think influence gold, but in fact are not so important or need to be qualified. So let's start by saying, is this gold's year? Well, certainly last year was not, much to many investors' disappointment. And the reason for that disappointment is most investors tend to have a rather simplistic view of what drives gold. They think inflation goes up, therefore gold goes up. And of course, the reason people think that is because of most of the recent experience, relatively recent experience in the 1970s, when gold, in fact, did move with inflation. And you can see that on this graph here. And as inflation came down in 1980, then gold also came down. And so in people's minds, it's been fixed, if you like, that higher inflation means higher gold prices. And even recently, we've seen that this is after the great financial crisis. Gold is a reasonably good correlation. We did have that bump in CPI at the end of 2009, but basically gold moved with inflation. Now, in fact, on a longer term historical basis, inflation in and of itself, let me say that, inflation in and of itself is not the main driver of gold, and it's certainly not the best economic environment for gold, particularly when you look at gold in real terms versus other assets. And so I just want to pull up a chart. You know, we won't have time to look through this very in great detail, but basically it shows the performance of gold during inflationary periods and the performance of gold during deflationary periods. And notice we look at the purchasing power of gold, not the nominal price of gold. And this comes from a book called Golden Constant, the English and American Experience, 1560 to 1976. But in fact, in the book, he goes all the way back to the early 13th century, the early 1200s. And he looks at Roy Jastrow, the author, looks at the annual increase or decrease in the price level and the annual price of gold. And the conclusion is quite clear that in purchasing power terms, gold performs better in deflations. And there are reasons for that. Now, in nominal terms, it does go up in inflations. And so it's a good asset to hold in inflations. But there are other things that also do well in inflations, such as typically real estate, collectibles, even stocks tend to be a good place to be during inflationary periods. In deflations, you're basically looking at cash, bonds, or gold. And so gold is the only asset that does well in both inflations and deflations. That's a very important point. And it holds its purchasing power over the long term, over the very long term, in fact, it holds its purchasing power. Now, another reason that people were disappointed with gold last year was they said, well, we've got a war in Europe. Surely that's good for gold. And I'll just put up a couple of slides here. I don't expect you to look at everything here. There's a lot on the graph, but it looks at gold from 1977 And it looks at various geopolitical events, President Reagan shot, the Lebanon war, Soviet invasion of Afghanistan, and so on. And we go all the way through to last year. You'll have to take my word for it. I'm happy to send these slides, by the way, to anyone who wants them, but you don't have time to look in great detail in this. But the reality is that geopolitical events have a positive impact on gold, but a very short-term positive impact on gold. And much more important than the political event is the direction of gold leading up to that event. So if gold is already doing well, and we have a negative geopolitical event, then gold will tend to go up nicely. If gold is declining, it'll be a very short-lived and minor blip. And so with the Russian invasion of Ukraine last year, you can see that gold was moving up already from September, October of the year before, as the situation heated up and rumors started and troops were moved. Gold moved up quite nicely. Then with the actual invasion, we had a sharp spike, and less than a month later, we were back to where we were. And of course, 6 months later, we were even lower than where we started this. So that frustrated a lot of people, but in fact, it's not an unusual pattern for gold. Geopolitical events tend to be very, very short-lived, and are normally a good opportunity for taking profits, not for investing. Having said that, we had inflation, we had the Ukraine invasion, but of course we also had higher interest rates, and higher interest rates, which went along with a stronger dollar, is what was really holding gold back. But despite that, gold actually held up quite well last year. It was essentially flat on the year. Silver was up. Silver was one of the very few things that were up in a year that saw virtually every asset of every type around the world down, other than commodities and cash. So gold actually held up quite well. And in terms of other currencies, in fact, gold did very well. Only against the Brazilian real and the Mexican peso did gold decline. Those were strong currencies. But against most currencies, in terms of most currencies, gold actually did well last year. And this brings me to one central point, and that is that one of the most important determinants of the gold price, and this is very, very logical, is the value of the currency in which you are valuing gold. We look at this graph here. It shows that gold, this is a pretty clear illustration. This is from 1998 to 2022. So 25 years basically. The gold moves up when the dollar is weak, and gold declines when the dollar is strong. And that's fairly straightforward, and that is the most important determinant. That's not to say that gold can't move up when dollar is strong. And in fact, in strong gold markets, such as the second half of the 70s, in strong gold markets, gold will move up in terms of all currencies. But most of the time, and particularly at the beginning of a bull market, we need a weaker dollar for a stronger gold priced in dollars. Now, the other major factor that affects gold, and this is a little more complicated, the dollar straightforward, is interest rates. And, you know, I'm looking at, again, this is from 1993, so we're looking at 30 years here. And, you know, there's not really much of a pattern. At the beginning of this period, Fed funds rate, interest rates went up, gold stayed where it was. Interest rates came down, gold stayed where it was, interest rates went up, gold went up. So there's really not much of a pattern here with gold and interest rates. What is much more important than the actual level of interest rates or the direction of interest rates even in real terms, so taking away the level of inflation to get the real interest rate, what's much more important is whether the market thinks that interest rates are going to continue to move up. And we see this very, very clearly in the second half of the 1970s, after the mid-decade recession, excuse me, when inflation was moving up, interest rates were moving up, gold was moving up. But notice this, in 77, 78, and 79, gold continued to move up and inflation continued to move up despite interest rates moving up. And poor old Arthur Burns gets a bad rap as the worst Fed chairman in history, and maybe he was, but people forget. But for those 3.5 years, Arthur Burns, the Fed under Arthur Burns, was continuously raising interest rates. They were raising interest rates all the way up, and they got interest rates to double digits. So this was no uber dove. The problem was that they were always behind the eight ball. They were always lagging inflation. They never really got ahead of it. And the market simply didn't believe that the Fed under Arthur Burns was going to do what was necessary to quash inflation. Now, when Volcker, we had James Miller for a brief period in between Burns and Volcker. When Volcker came in, you know, he was a very tall man, he was gruff, he smoked a cigar. When he looked at you in the camera and said, I'm going to kill inflation without a smile, and it'll mean a recession, people believed him. And of course, he jacked rates up. The treasuries went to 17% and short-term treasuries, and the Fed funds rate went to nearly 20%. And at that point, inflation came under control. And the difference between the two environments was that Volcker got ahead of inflation, right? He got ahead of inflation. I mean, just look at this in some numbers. You know, inflation in 71, 78, 79, 19, and 79, inflation was always ahead of interest rates, even though interest rates rose dramatically in that period. In fact, from 78 to 79, they almost doubled, and they went to double digits, but they were still behind inflation. And you can see what happened to gold. When rates went to 22% and inflation was only half of that, gold peaked at 836 and came down. So that's the critical factor. Does the market believe that the Fed will get rates above inflation and stay with it sufficiently to bring inflation down? And where are we now? Well, CPI is at 5 and rates are 4.75. Tomorrow they will probably go to 5%, so we'll be matching. But you need to get rates above the level of inflation and meaningfully above the level of inflation, as happened in 1980, in order to kill inflation. So let's look at the recent period, and you can see in this period, and this illustrates something that I was saying right at the very beginning. Gold was moving up at the end of last year and the beginning of this year, even as the CPI level was coming down. So it's not the absolute CPI level. It's not even a direction of the CPI. It's, does the market believe that the Fed is going to continue until inflation is squashed? And March, in the lead up to the last Fed meeting and around the Fed meeting, the market thought that the Fed was going to pivot. The market believed that the Fed did pivot. I think they exaggerated that, frankly, and we can talk about that later. But the reason gold moved up so dramatically in March, $250, which is very significant, was because the market believed that the Fed was going to pause, that it had pivoted, and the Fed funds rate, which is a market, the futures rate, the Fed funds futures, which is people betting with their real money, is forecasting a decline in rates by the end of this year of 80 basis points. I think we're optimistic. We can come to that later, but the point is that's why gold moved up. Now, some people are very concerned. Well, okay, this Fed may not kill inflation, but it sure looks as though they're going to kill the economy. And I certainly agree, but we are heading into a recession. That is very, very clear, and is going to be far worse than a mild recession that some of the staff at the Fed seem to think may happen by the end of the year. It's going to be worse than a mild recession. Well, how does gold perform? Most people, if you just ask them, just as they would say, inflation, good for gold, right? This would demonstrate, this graph would demonstrate that's not always true, not in that precise or simplistic manner. And if you said to them, what about recession? Most people would say, bad. Well, let's just have a look at how gold, in fact, performed in recessionary periods. These are the 7 recessions, I think 7, going back to the early 1970s. And every single one except one, gold was up. And the one where gold was down, it was down less than 0.5%. And that was, if you remember, when the central bank started aggressively selling gold. So that's a pretty good track record for gold during recessions, which again goes back to a recession is not a deflation, of course, but it harkens back, it echoes what I was saying at the beginning, that in deflations, gold does better. Now, what about gold stocks? You would think that gold stocks would do badly during recessionary periods. In fact, in the majority of recessions, gold stocks did well. And they didn't just do well, but they were up 44%, 190%, etc. They did very well during recessionary periods. That 190, just look at it for a second, is from January 80 to July of 80. We're talking half a year and the stocks were up 190%. Look at the last one, we're talking 3 months and gold stocks were up 24%. In the ones in the 3 in which they went down, in 2 of the 3, they did better than the S&P. So the conclusion here is that gold is definitely a good asset to hold in a recession, and gold stocks are also a good asset and better than holding the broad market. Now, what about if we do in fact have continued persistent inflation and a slowing economy, sluggish economy? And that's what I think we're going to have, a stagflationary period. My own assessment is the CPI rate will probably come down for another month, maybe 2 months, and it will fool people into thinking that inflation is finished. But unless we get inflation well under 2%, inflation is going to come back. And there are some hard reasons to say that. First of all, the oil price, of course, bottomed at the end of, towards the end of March. And so that feeds its way through to transportation costs, which feeds its way through to the cost of all sorts of stuff that we buy at grocery stores. It has to be shipped. But that takes a month or 2 to come through. Housing or apartment rents is another one, where rents have been coming down, but in the last 3 months, each month, apartment rents have moved up, but not yet reflected in the CPI because of the peculiar way that the Bureau of Labor Statistics calculates rents. And so, but rents are apartment rents have been moving up for 3 months in a row now, after heading down for the previous few months. And that is the largest component of the CPI, is what they call owner's equivalent rent. And that will feed through those rate hikes, those increases we've already seen will feed through into the CPI numbers. So I suspect we'll see a bottom in the CPI, maybe in June or July, and then it'll start to move up again. But I suspect also that the Fed will think that they have conquered inflation at that point. So I suspect we're going to get persistent inflation and a slowing economy. And in a stagflationary period, gold has proved over time to be the best performing asset during a stagflationary period, followed by commodities. Small EM means emerging market, but let's call them smaller market bonds and stocks. And this is quite clear. So I think the economic environment into which we're heading, inexorably heading, is very positive for gold. Gold over this century so far has actually performed very well, and the gold stocks, the XAU gold stocks, have lagged. It is time. There's lots of reasons of that we can talk about, but it is time for the gold stocks to catch up. Prior to 2008, they used to trade in tandem, with the gold stocks normally doing 2 or 3 times as well as gold, moving 2 or 3 times as much as gold on the upside and the downside. But the correlation was very, very close. That correlation was broken basically in 2008. Not only is it time for the gold stocks to catch up, not only is the environment for gold stocks a very, very good one, but they are remarkably inexpensive. This is just an illustration of the XAU stocks based on cash flow, price to cash flow. And you can see that even though gold is at $2,000 today, and normally when gold moves up, you get multiple expansion. So you would expect, and we saw this in 2003, 4, 5, as gold moved up, the multiples expanded. But the gold stocks today are selling close to, not at, but close to their lows on cash flow. And you could look at price to cash flow, where in the low is 25%. You could look at price to NAV, where the gold stocks are trading essentially at the lowest level in 30 years, other than the end of 2014. And you could look at many, many metrics to see that the gold stocks are undervalued on a historical basis. Not only is the environment good, but people seem to forget that the profit margins are really quite good right now and have been for the last couple of years. You know, if you're selling your gold at $2,000 and your cash costs of producing it are $850 to $950, which they are for most of the major miners, and your all-in sustaining costs, which includes the cost of replacing your depleted ounces, your all-in sustaining cost is $1,250 to $1,300. That is a very, very strong margin that companies have on their production. Now, not only are the gold stocks cheap on a historical basis, but they're also very unusually better value than the S&P. This is very unusual. Gold stocks typically trade at high multiples, high valuations, because let's face it, to invest in a gold stock, you have to be a little bit of an optimist. There's very rarely do you see value stocks, true Graham and Dodd type value stocks in among the gold stocks. And yet right now, the gold stocks are trading at better valuations on dividends, price to book, price to cash flow, better valuations than the S&P. So I'll stop there and give a little bit of time for questions. But basically, let me just sum up. It's not just inflation. It's whether the market believes that the Federal Reserve and other central banks have the fortitude and the capacity to kill inflation, not to bring it down and then let it be resurrected. You know, it's like taking an antibiotic only for 6 days. It comes back stronger if you don't kill I was going to say kill the patient, kill the disease, and a slowing economy. So a very good environment, macro environment for gold. Gold stocks are making money, and gold stocks are very, very undervalued right now. So with that, I'll take any questions that anyone might have.
Okay, very good. Do you have a guess on what year the gold might peak?
I'm sorry, say that again. Do I have a guess?
Do you have a guess on what year gold might peak?
On what year gold might peak? Wow. I'll give a JP Morgan type answer, in the future. I think we're a little bit away from that. I'm not at this point looking at where gold will peak. I think we've got a few years ahead of that. We're not talking this year or next year. We've got a few years ahead before gold peaks.
Why do the gold stocks rise during recessions?
Well, that's a good question. I think people are looking for, first of all, gold stocks continue to make money during recessions. You know, if you're looking at a company that makes automobiles or a company that makes washing machines, their sales go down during recessions. If you're looking at companies that need to raise a lot of money, you know, tech companies or whatever, it's more difficult to raise money during recessions. But gold is something that can continue to be mined and produced, and a recession just doesn't affect the sales that much. Obviously, it affects jewelry sales, but it doesn't affect the monetary demand for metals.
Okay, do you have any thoughts on silver for this year?
Yeah, silver, I mean, the basic story, and I'll answer this year in a second, but the basic story with silver obviously has characteristics that are different from gold, both on the demand side, much more industrial demand, but also on the supply side. And critically with silver, there are no huge supplies of above ground silver, unlike gold, where central banks have gold that potentially could be sold. There are no large stockpiles of silver. And secondly, this is important for people to understand, and it is a complete change in the silver market from, say, 30 or 40 years ago. Most silver today is byproduct silver. Some is byproduct of gold, some is a byproduct of copper, and a lot is a byproduct of zinc or lead. What that means, excuse me, what that means is that the silver production, the silver supply does not respond to changes in the demand for silver. You know, if you get a change in the demand for gold, companies can produce more, and if the change in demand lasts a long time, they can bring more mines onto production, they can expand production and so on. But with silver, the lead miner in Bolivia, or the tin miner in Bolivia, or the zinc miner in Peru, he's not going to increase his production of zinc or lead or tin just because he sells a little bit of silver on the side. So silver supply does not respond to changes in the demand for silver. And what that means is that silver has potential to have, of course, sharper declines, but also much sharper increases than gold does. And so it remains a monetary metal. If you look at the last 25 years, even since the supply-demand dynamics that I just described have been in place, silver has still responded much more to monetary factors than to industrial factors. And so you get a move up in gold. If gold gets to 2050, 21, then people will start to look to buy more silver, and we won't get an increase in the supply of silver. So silver has the potential for much sharper moves than does gold. This year, yeah, but they tend to be short, they can be shorter lived. This year, I wouldn't be at all surprised if we got to between 30 and 35 on silver at some point. I'm not saying it'll stay there, and I'm not saying that's where it'll be at the end of the year, but I think that's definitely a potential.
Well, very good. Thank you. That does conclude the time for this session. I want to thank you
Okay.
all again for joining us, and thank you, Adrian, for your awesome presentation today.
Well,
And-
thank you very much, and I'm happy if we didn't get to any questions. If people want to write to me, I'm happy to. Let me get to them. If people want to write to me, I'm happy to attempt to answer the questions.
Okay, well, thank you all for joining us. Please stay tuned as we have more presentations in store for you for today and tomorrow.
Okay, thank you. Was that okay? Anyone there? No.
Yes, that was very good.
Oh, okay. I'm sorry. Yeah, okay. Well,